Exercise 4-19, we're going to prepare financial statements from a worksheet. So VoiceLink's completed worksheet as of November 30th is as follows. So we click on here. Now this is kind of small. I'm going to readjust the size. You at home might decide to print it, whatever works best for you. All right, so requirement, we need to complete the income statement for the month ended November 30th. Complete the income statement for the month ended November 30th. Use a minus sign or parentheses to show a net loss. If a box is not used in the income statement, leave it empty. Do not enter a zero. Do not enter a label. All right, so before we can do the financial statements, we need to know the formulas for the financial statements. So the three financial statements are the income statement, statement of owner's equity, and then the balance sheet. So since we're starting off, as always, with income statement, our basic formula is revenues minus expenses equals net income or net loss. So we know we're going to have revenues minus expenses. So let's get back to our worksheet, which again was retrieved by clicking on that icon. And we're going to go over to the worksheet's income statement columns. These are the only columns we need to do the income statement. We're going to scroll down, and here's our first revenue. We've got service revenue, and then we're of course going to take the 9,200. I'm going to copy that, and then paste it here, and the label is service revenue. Next, we have our expenses, starting with depreciation expense of 300. Now, most companies will do their expenses, will list their expenses from largest to smallest. So let's start with $2,600, and that's for salary expense. Salary expense, $2,600. And again, we're only using the income statement columns. And the debits are the expenses because expenses normally have a debit balance. So the next largest is $900 for rent expense. And then our next biggest is $700 for utilities expense. And remember, the worksheet always has the expenses last and second to last for the revenues. That's why I know I can go down here to the bottom. All right, next we've got $500 for supplies expense. And that was $500. So next one, last one, we have $300 for depreciation expense. So we got 1, 2, 3, 4, 5 expenses. And we got 1, 2, 3, 4, 5 expenses for a total of $5,000. Of course, you should double check, add these 5 up, make sure that they equal $5,000. Total expenses. So now we can subtract revenues, or we can take revenues, subtract our expenses, and we get $4,200 of net income. Check answer. Good job so far. And let's just scroll back up there. In case you're wondering why we have multiple columns, notice there is no debit and no credit. So these are not debits and credits columns. These are just formatting columns. Some companies even have 3 columns, depending on how many expenses they have and how complicated it is. So what they're doing in this right column is they're just putting the 3 most important numbers: total revenue, total expenses, and then our net income. And then if someone is curious as how this $5,000 breaks down, then they can look over here in this other column. So that's the only purpose for having these multiple columns, is just for formatting. Next, we're going to create the statement of owner's equity for the month ended November 30th. Assume that there are no contributions made by the owner during the month. So let's get back to our my financial statement formula. So now we're working on the statement of owner's equity. So all the statement of owner's equity shows is how did capital change over the period. So we have the beginning capital and the ending capital, and then the 3 things that affect capital. Now, the first thing we're going to have that affects it is investments, also known as owner contributions. So beginning capital plus investments plus net income minus draws. So our beginning capital we get from here, $36,400 for capital. We know that's the beginning because it says November 1. And then next we add investments and net income. So for investments, remember it said investments are also known as owner contributions. There were no contributions, so we're going to skip that. So the next thing is we take our net income from up here and we add that. And we get our subtotal of $40,600 by adding these 2. And then the last thing we're going to do is we're going to subtract our draws, also known as withdrawals. So going back to our withdrawals right here. So it looks like this $2,400 is our total withdrawals. Owner withdrawal. And to remind me to subtract that, I like to put in a minus sign. And then you can also do parentheses. So I'm now going to take 40,600, subtract 2,400, and I get $38,200 of capital at the end of the month, November 30th. So it looks like our capital increased from 36,400 to 38,200. Check our answer. Excellent. All right, now we're going to go and do our last one, the balance sheet. Now the simplified version of the balance sheet, the simplified formula, is assets equals liabilities plus ending capital. But now we're going to do a classified balance sheet. Classified balance sheet just means they're going to break out the assets into current assets and then long-term assets, though no one ever calls them that. They're usually called plant assets or property, plant, and equipment, or fixed assets. So the definition of current assets are assets that you expect to be used up or turned into cash within the next 12 months. Plant assets are assets that are going to last longer than 12 months, such as your building, your equipment, your vehicles, etc. So let's get back to our worksheet. Now, we're working on the balance sheet, so we're only concerned with these columns over here. And notice that the order of these assets, they always list the current assets first. So let's see, which one of these are current assets? Cash, AR, you expect to receive and turn into cash within the next 12 months. Prepaid rent, you expect to use that up in 12 months. Office supplies, you expect to use that up in 12 months. Equipment. So equipment is the fixed asset or the plant asset because it's going to last a long time. And then these first four are current assets. So assets are listed in order of liquidity. Liquidity means which ones are going to be turned into cash first. And the last one, equipment, which one is the one that's going to be turned into cash the slowest or the furthest into the future. So we've got cash, $3,900. So I'm going to copy cash. And then we've got AR of 4,300. Accounts receivable. And then we've got prepaid rent of 700. And then we've got office supplies, $3,400. Okay, now I'm going to add these up, and that gives us our total current assets. And when I add those up, those become $12,300 of current assets. In other words, assets we expect to use up or be turned into cash within the next 12 months. Plant assets. We've got our equipment and then the associated accumulated depreciation on that equipment. So we're going to start with equipment. We've got $33,400 of equipment. It's a plant asset because we do not expect to use it up or turn it into cash in the next 12 months. And then less, notice less, the label less, that's reminding you that we need to subtract our accumulated depreciation. So the accumulated depreciation on the equipment is $1,800. I'm going to put that as a minus to remind myself to subtract. You can use parentheses also. So when I take 33,400, subtract 1,800, we get our book value, or also known, in this case, since there's only one asset, since there's only one plan assets, it's our total plan assets. So 33,400 minus 1,800 gives me 31,600. So the book value of this equipment is 31,600. Book value is just the cost of the asset minus its accumulated depreciation, and I forgot to put in the label. There we go. And then we're going to take our current assets, 12,300, add our total plan assets, and that gives us total assets of 43,900. Now, before we can move on, it's going to have us check our answer to make sure our total assets are correct. Well done. Then it's going to move us to liabilities. So again, we're still working on the balance sheet. So our liabilities are after, again, we're only looking at the balance sheet columns. Liabilities are after our fixed assets, our plan assets, and its accumulated depreciation. So now we have accounts payable of 5,100. So these are current assets, current liabilities. So on this classified, remember we're making a classified balance sheet. On the classified balance sheet, we have to divide our liabilities into liabilities that are current liabilities, in other words, ones that we have to pay within the next 12 months. And then if they have anything that's due past 12 months, those would be considered long-term liabilities. Now, why is it important to break up these two? Well, which one is more important to know? The company's current liabilities or long-term liabilities? Well, the current liabilities are more important because they're due first. If they can't pay their current liabilities, then there's no way they're going to exist probably to get around to paying their long-term liabilities. So that's why current liabilities are listed first. So now we need to list our current liabilities. Our first liability, let me use this as a straight edge so I can read this. Accounts payable, we've got $5,100 of accounts payable. $5,100 of accounts payable. So after our accounts payable, we've got salaries payable of $600. And let's see if we have any more. Let me use this as my straight edge. After salaries payable, we've got capital. So we're done with capital as an equity account. So we are done with our liabilities. They don't have any long-term liabilities, so we're not going to have a section called long-term liabilities. So this is going to be considered total liabilities. And our total liabilities is 5,100 plus 600 gives us $5,700 of current liabilities. Now, equity. Now, this is the part where some students screw up. Let's go back to our formulas for the financial statements. Notice the balance sheet. The formula is assets equals liabilities plus ending capital. So where did we get ending capital from? Follow the arrow backwards. The ending capital is at the end of our statement of owner's equity. So we're going to scroll up to our statement of owner's equity. Here is our ending capital, $38,200. I'm going to copy and paste that. And that's Terlingua capital. So now what we're going to do is we're going to take our liabilities and add them to owner's equity. Why? Well, that's the formula for the balance sheet. Assets equals liabilities plus capital. So when we add these two together, 5,700 plus 38,200, they better equal this. And they do. And then this label is total liabilities and owner's equity. So if these two numbers don't match, total liabilities and equity versus total assets, you need to go back and troubleshoot to see where you went wrong. And that's it.